Hello friends, welcome back to Market Whisper. I am your host, and this is where we peel back the curtain on India's most fascinating companies. Today, we are stepping into the aromatic world of SH Kelkar and Company Limited. Yep, the folks who make your soap smell divine and your snacks taste irresistible. Not a household name, right? But trust me, they're the unsung heroes of India's fragrance and flavor game. Picture this, a century-old Mumbai-based powerhouse, the biggest in its league here, crafting scents and tastes for everyone from global FMCG titans to scrappy startups. They're listed on BSE and NSE, and their stock has been quietly simmering along. So grab your coffee or, hey, maybe light a scented candle, and let's unpack their Q3 fiscal year 25 earnings to see if this one's still a sweet deal. Ready? Let's go. Alright, let's dive into the management update from SH Kelkar's Q3 fiscal year 25 earnings call, delivered fresh on February 22nd, 2025. The headline? They raked in rupees 1556 crores over 9 months, a juicy 17% jump year-on-year in sales growth. Not bad, huh? Especially when India's FMCG scene is feeling a bit blah. Small and mid-sized accounts were the most valuable players here, keeping the momentum alive. Over in Europe, they have notched an 11.8% revenue boost. Think strong product mixes and some lucky regional wins. And the flavor segment? Oh, it's cooking, bouncing back from a low base with solid profits. But it's not all sunshine and roses. Raw material prices spiked hard this quarter. The droughts in Indonesia and Brazil are the culprits, and that squeezed gross margins. Management is not sweating it too much, though. They are banking on pricing tweaks and better supply to smooth things out. EBITDA margins? A healthy 17%, even with big bets in Europe and the US jacking up costs. Debt is up to rupees 703 crores, thanks to a Q1 hiccup, probably a fire at their plant, and a rupees 50 crore GST refund that is stuck in limbo. Still, they are all in on a 3-year plan to grab market share and crank up the leverage. So, what's the vibe? Cautiously optimistic, I'd say. They're pumped about growth. 17% is no joke, but they are real about the bumps. Raw materials, geopolitics, cash flow snags. The management's tone is grounded, like they are saying, hey, we've got a plan, but it's a long game. They're keeping us hooked on the future without dodging the now. Pretty balanced, right? Now, let's get to the juicy part. The investor Q&A. Analysts came ready with questions, and management didn't hold back. First up, that rupees 45 to rupees 48 crore spent on creative centers. It's fueling Europe, UK, Germany, and the US, targeting local wins and at MNC headquarters. No big new cash drops planned. Just some inflation tweaks next year. On gross margins, analysts zeroed in on that raw material jump. Citrus and spices got pricier thanks to those droughts in Indonesia and Brazil. Management is like, we've hiked prices now, so expect a rebound by fiscal year 26, though fingers crossed on the rupee-dollar FX rate. Growth? They're sticking to a 12% compound annual growth rate, with fiscal year 25 likely topping 17%. Door. For fiscal year 26, think 12% to 14%. All volume-driven, new markets, like Southeast Asia, are heating up, though big Indian accounts slowed post-Diwali. The debt talk got spicy about rupees 703 crores, up from rupees 540 last year. Rupees 140 crore is from fire-related inventory losses. Rupees 75 crores capex, mostly insured, and rupees 50 crore is that GST mess. They're eyeing in rupees. 100 crore debt drops soon, plus an insurance payout any day now. Oh, and flavors? Rocking a 22% EBIT way ahead of fragrances. They say it's a post-investment boom, but fragrances will catch up soon. Risks? Competition is the biggie. They've been snagging market share, and they are not slowing down. In short, management is chill about growth, tackling debt with a plan, and betting on flavors and new term. Analysts pushed on volatility. They admitted it's part of being a growth-hungry player. Solid answers, with a dash of trust us. It's not over until it's over. So what would Peter Lynch? Yep, the Fidelity's Magellan Fund legend make of SH Kelkar. He loved simple, steady, under-the-radar stocks, and this one has got the same vibes. He would say, "You are buying the scent in your shampoo, the kick of that taste in your chips, easy peasy." A proxy to consumption in India, no matter the sentiments or consumer spending. Growth? That 17% a pop and 12% compound annual growth rate would perk him up. P's around 2025 historically. Fair for a double-digit runner. He'd like that 17% EBITDA margin too. Profitable, not glitzy. Management's market share hustle would get a nod. But he did carefully look at the rupees, 7.3 crore debt, and GST delay. Lynch liked tidy books. Still, it's a classic Lynch, stalwart. Not a wild 10-bagger, but a 10% to 15% grower if they can trim debt and keep stealing the market share. He'd probably say, buy it if you can stomach the wiggles. It's a sleeper hit in a boring but gold sector. Sounds like Lynch, right? Time for some goodies. Let's look at SH Kelkar's rivals and the industry's runway. Big listed competitors? Simrise Germany-based, Givaudan Switzerland-based, and IFF US-based, all global heavies in fragrances and flavors. SH Kelkar is smaller but nimble, especially in Asia. Locally, its Privy Specialities unlisted but feisty, and Oriental Aromatics, listed on BSE, is a scrappy peer. The industry? $30 to $35 billion. Globally, in 2025, growing 4% to 5% yearly. India's $1.5 billion chunk is racing at 8% to 10%. Think rising incomes and fancy tastes. Flavors are outpacing fragrances globally, and SH Kelkar's riding that wave. Risks like raw material swings loom, but it's a sticky, downturn-proof, or let's say recession-proof niche. So, they're up against giants, but with India's boom and export chops, this could be a fragrant winner. Hit us up with your thoughts via comment section. Do like and subscribe. That's it for today, folks.